Here's something that should be mathematically impossible. The United States housing market just posted its lowest transaction volume since 1995, meaning fewer homes are selling right now than at any point in 30 years, and in the same breath, home prices are sitting near all-time highs. Simultaneously, fewer people buying, higher prices. In any normal market, those two things cancel each other out. That's how supply and demand works. You learned it in 8th grade, so did I. And yet, here we are. The market is frozen, the prices are absurd, the average first-time buyer is now 40 years old, and if you've tried to buy a home recently, you already know something is deeply structurally wrong. You just can't quite put your finger on what. My name is Nick, and today we're going to do something the real estate industry, the mortgage industry, and most financial media would genuinely prefer you not do. We're going to explain exactly what happened to this market, every domino in order with the actual numbers, so that when you make your next move, you're making it with your eyes open. Hit subscribe if you want to keep running the real math. Let's get into it. The median existing home price right now is about $418,000. In 2019, 7 years ago, it was $272,000. That's a 46% jump. Not in Manhattan, not in Palo Alto. Nationally, the median, the dead middle of the entire country. Mortgage rates are sitting around 6.5%, which sounds manageable until you remember that in January 2021, you could get a 30-year fixed mortgage for 2.65%. That is a completely different financial planet. Here's what that gap means in actual dollars. Same house. $400,000 purchase price, 20% down, $320,000 mortgage at 2.65%. Your monthly payment is $1,293. At today's 6.5%, that same loan costs $2,023 a month. That's $730 more per month, every month, for 30 years. For the same house, same carpet, same school district, rated a 6 out of 10 on a generous afternoon, same yard the size of a generous parking space, and the house itself costs $146,000 more than it did 6 years ago. So you're paying more for the loan and more for the house. Both at the same time. This is not bad luck. It is the output of a very specific sequence of decisions and shocks that piled on top of each other over 5 years. And once you understand the sequence, the current situation stops feeling like chaos and starts feeling like an almost inevitable outcome. The year is 2020. The world is on fire. Metaphorically, mostly, and the Federal Reserve, in an act of emergency financial panic, slashes rates to basically zero and starts buying $120 billion in bonds and mortgage-backed securities every single month, injecting money into the financial system with the commitment of someone who has started a bonfire and is now slightly worried they may have used too much lighter fluid. By January 2021, the 30-year fixed mortgage hit 2.65%, the lowest rate Freddie Mac had recorded since 1971. People who'd been sitting on the fence about buying suddenly realized they could afford dramatically more house for the same monthly payment. So they bought and bought and bought some more. But that was only half the fuel. COVID rewired what Americans needed from their homes. Suddenly, your apartment was your office, your gym, your school, your restaurant, and your primary human contact. A 700 square foot place in the city that used to feel fine suddenly felt like a sensory deprivation tank with a Wi-Fi password. Remote work exploded from under 6% to over 18% almost overnight, and millions of people started asking a reasonable question. If Chicago and Los Angeles each lost tens of thousands, and all of them descended on Austin, Phoenix, Boise, Nashville, Tampa, places with already tight inventory that suddenly had a stampede of buyers with pre-approvals, pandemic savings, and a desperate need for a home office that wasn't also a closet. National home prices jumped 37% between March 2020 and March 2022. Not over a decade, 2 years. Austin climbed 61%, Phoenix 59%, Boise, Idaho, Boise up 53%. At the peak, nearly 6,000 homes sold for $100,000 or more, above asking price in a single month. For a normal house where someone was going to do normal things like make dinner and argue about whose turn it is to take out the trash. If you bought in 2020 or 2021, you probably made one of the best financial decisions of your life almost entirely by accident. That's not skill, that's timing. And for everyone who wasn't in a position to buy during that window, what happened next made everything dramatically worse. By mid-2022, inflation was running at 9.1%, the highest in 40 years. So the Fed did what central banks do. They raised rates historically aggressively, 11 hikes in 16 months from 0.25% to 5.50%. The fastest tightening cycle in 4 decades. Mortgage rates followed in the worst possible direction. January 2022, 3.22%. October 2022, 7.08%. October 2023, 7.79%. The highest since 2000, 7.79%. On the same houses people were paying $100,000 over asking for 18 months earlier. At 7.79%, that $320,000 mortgage now costs $2,302 a month versus $1,293 at the pandemic low. That's over $1,000 more per month, $363,000 more over the life of the loan for the same exact house. To buy the median priced home at today's 6.5%, you need to earn around $106,000 a year just to qualify. The median household income is $83,700. The average American family is $22,000 per year short of qualifying for the average house. And every single quarter point rate increased prices roughly 1.4 million additional buyers out of the market entirely, not fewer buyers gone. Home sales fell from 6.12 million in 2021 to just over 4 million in 2025, marking the slowest 3-year stretch the market has seen since the mid-90s. We are selling fewer homes today in a country with 100 million more people than 1995 than we sold in 1995, the thing that is quietly holding this entire market hostage. Right now, about 51% of all outstanding U.S. mortgages carry a rate below 4%. Roughly 20% carry a rate below 3%. If you bought in 2020 or 2021 and locked in 2.75%, you are sitting on a financial instrument that no longer exists. The bank will not recreate it. The market cannot offer it. It is gone like a limited edition sneaker that sold out and never restocked. So if you sell your house and buy another one today, you're not just moving. You're voluntarily surrendering the cheapest money you will almost certainly ever access in your lifetime and replacing it with money that costs more than twice as much, at over $65,000. $65,000 to leave, so the rational homeowner stays in the house that's too small, in the nursery that's become a Zoom background, in the neighborhood where they stopped knowing their neighbors 3 years ago, not because they want to stay, because a spreadsheet is physically keeping them there. The Atlanta Fed found this effect reduces the probability that any homeowner lists their home by 21 to 23%. FHFA researchers estimated it has suppressed 1.7 million transactions that would otherwise have happened. Active inventory is still 17% below 2019 levels. Months of supply hovers between 3.3 and 3.8. You need 6 for a balanced market. The market isn't broken in the sense that it's collapsing. It's broken in the sense that it has completely stopped moving, like a door that won't open or close, just stuck, vibrating slightly, going nowhere. And if you want to understand who's actually getting squeezed hardest, we need to talk about someone specific. Let's call her Maya. She's 31, works in healthcare administration in a normal mid-sized city, makes $74,000 a year above the national median, no credit card debt, a 760 credit score, $31,000 saved over 3 years of genuine sacrifice, skipped vacations, no new car, one roommate longer than she wanted. By any reasonable standard, Maya is exactly the person homeownership was designed for. Here's what the market offers her in return. The median home in her city is $385,000. With 10% down, her loan is $346,500. At 6.5%, her monthly principal and interest is $2,190. Add property taxes at $350, insurance at $150, maintenance, saving a house you know you can't afford just to have somewhere to put the feeling. It feels like watching your rent go up $150 in March and realizing your down payment timeline just got 3 months longer. For a deposit you've been building for 3 years, it feels like going to your best friend's housewarming, genuinely happy for them while involuntarily calculating what their monthly payment must be. It feels like being responsible by virtually every measure and still being systematically kept out of the thing your parents treated as a basic expectation of adulthood. First-time buyers now make up just 21% of all purchases, a record low in 44 years of tracking. The historical norm is 40%. The median age of a first-time buyer is now 40. In the early 1990s, it was 28. Buying at 40 instead of 30 costs roughly $150,000 in lost lifetime equity from the decade of appreciation you missed. Baby boomers now make up 42% of all buyers. Half of older boomers are buying entirely in cash. They sold a house they bought for $200,000 in 1998 that's now worth $700,000, pocketed the equity, and walked in with no mortgage dependency while the 32-year-old is trying to win a bidding war with a pre-approval letter and $31,000 saved. The downstream result: 84% of Gen Z aspiring homeowners are delaying at least one major life milestone because of housing. 29% are postponing having children, 18% are delaying marriage, 1 in 6 aspiring buyers, and 22% of millennials have given up on homeownership entirely, not paused, given up. The median first-time buyer being 40 years old is not a quirky data point. It's the statistical fingerprint of a generation squeezed so hard and for so long that the defining marker of middle-class stability has been pushed from early adulthood into middle age. And every institution with a financial stake in you buying a home has a structural incentive to tell you now is a great time to buy. None of them make money when you say no. Here's what almost never gets enough airtime. The shortage didn't start in 2020. It was assembled piece by piece over 15 years of underbuilding after 2008. The US is short somewhere between 3.5 and 4.5 million housing units. After the financial crisis, builders pulled back hard. For the entire 2010s, housing starts averaged about 990,000 per year against a historical baseline of 1.5 million. And what got built skewed heavily toward the upper end of the market, because that's where the margins are. The starter home, under 1,400 square feet, the traditional entry point for first-time buyers, went from over 400,000 units a year in the 1970s to just 65,000 in 2020, an 80% decline. The house that was supposed to be the beginning of the wealth-building ladder for working Americans was essentially discontinued as a product. Then came the pandemic surge, then the rate spike, and now tariffs, you steal up 50%, aluminum up 50%, Canadian lumber up 45% combined, adding an estimated $10,000 to $17,500 to the cost of every new home. The supply chain looked at the situation and said, "Cool problem, not our department." Builders are fighting back with incentives and rate buy-downs to 4.5% or lower, but the hard truth is this: the supply problem took a decade to create. It will take at least a decade to meaningfully solve. There is no policy lever anyone can pull that builds 4 million homes in 2 years. At some point in every housing market conversation, someone says it. Is this 2008? No, not even close. And the reasons it's different matter enormously. In 2006 and 2007, subprime mortgages made up 18 to 21% of all originations. Liar loans, interest-only products, negative amortization mortgages, mainstream products. The banking system was betting on home prices rising forever, using money borrowed against itself with zero margin for error. Couldn't repay it. Based on home values they largely invented. Today the problem is almost the inverse. The lending is sound, the borrowers are qualified, the equity is real, and you still can't afford anything. Progress, technically. This is not a fragile market. It's a frozen, structurally constrained, deeply expensive market. A crash at least creates buying opportunities. A frozen market that slowly grinds sideways mostly just continues to exist, absorbing more of people's income and waiting for time to do what policy can't. The thing everyone's waiting for is a significant drop in mortgage rates. It would genuinely help. Most forecasts have rates ending this year between 5.7 and 6.1%. Better, but a Bankrate survey found 37% of homeowners need rates below 5% before they'd even consider selling. That threshold isn't where we're headed this year. The lock-in effect fades naturally over time. People have kids, take new jobs, get divorced, retire. The share of mortgages below 4% has already dropped from its peak of 65% down to about 48% today. That slow release is the most realistic path to a more functional market, but slow is the operative word. This is a 5 to 10 year process. Now here's the twist almost nobody's talking about. A dramatic rate drop might not fix affordability. It could temporarily make it worse. Think about it. Millions of buyers are sitting on the sidelines right now. If rates drop to 5% quickly, that wave of pent-up demand floods back overnight. But supply doesn't recover overnight. The 3.5 million unit deficit took a decade to create. So what happens when massive demand hits insufficient supply? Prices spike. The same dynamic that drove the 2020 to 2022 surge could partially repeat at a higher base level. The cure, if it arrives too fast, could temporarily make the disease worse before it makes it better. The most honest forecast is the boring one. A slow, multi-year correction where prices move roughly sideways while incomes gradually rise. No crash, no dramatic relief, just time and grinding adjustment with a lot of difficult personal decisions in the middle. If you're in your late 20s or 30s right now, you are navigating the most dysfunctional housing market any generation has faced since World War II. Not the most dramatic. 2008 was more dramatic, but more insidious because this one doesn't feel like a crisis. It feels like a permanent new normal. And every institution with a financial stake in your decision has a structure and you plan to stay at least 7 years, buying makes sense. If the math doesn't work at that threshold, it doesn't work. Stretching to 45% of income because your real estate agent says it's a great time doesn't make it a great time. It makes you a future statistic. Renting and investing the difference is a completely legitimate strategy that almost nobody with a financial incentive will suggest, because nobody earns a commission when you put money in an index fund. In a high-rate, high-price environment, the math can absolutely compete with or outperform buying an overpriced house. This is not a consolation prize. If you are buying, look seriously at new construction. Builder rate buy downs at 4.5 to 5% are real, and the median new home price is essentially at parity with existing homes, something that almost never happens. Just make sure the incentives aren't disguising an inflated base price. Run every number. The housing market you're dealing with is the product of 30 months of the cheapest money in American history, followed by the fastest rate hike cycle in 40 years, layered on top of a decade of underbuilding that left the country 4 million homes short. The people who need prices to fall are priced out of buying even if they do fall. The people who need to sell are financially trapped by the very low rates that made housing affordable 5 years ago. Everyone is stuck at opposite ends of the same problem for completely opposite reasons, and there is no product, no policy, no executive order, and no rate cut that fixes a structural imbalance this large in a single year. The era of buying any house at any price and assuming appreciation bails you out is over. Running the real numbers before you sign is not pessimism. It's the only sane way to navigate a market this expensive and this broken. You're not crazy for looking at listings and thinking none of this adds up. It genuinely doesn't, and understanding exactly why it doesn't, that's the first step toward making a decision that actually works for you, instead of just participating in collective financial insanity because everyone around you insists that buying is always the right move. Now you do. Drop a like if this helped. It genuinely makes a difference. Subscribe if you want to keep running the real math together, and I'll see you in the next one.